Judging by both my clients and commenters on this channel, one thing more than ever tends to confuse people when it comes to their taxes. This video attempts to clear up this confusion. I'm the Tax Geek, and here is Tax Liability, oversimplified. I've mentioned the concept of tax liability many times on this channel, particularly when it comes to tax credits. So, what exactly is it? There's one thing that it's not, and that is a balance due on a tax return. Any balance due or refund usually has very little to do with the actual amount of tax you pay to the government. On a Form 1040, there are actually two tax liabilities, an income tax liability shown on line 16 and a total tax liability on line 24. Your aim should be to get the figure on line 24 to be as low as possible. But let's start by looking at the figure on line 16. This is your income tax as determined by your taxable income, the nature of that taxable income, and your filing status. It is determined by looking up your taxable income in a tax table if your taxable income is $100,000 or less, calculated using the tax computation worksheet if your taxable income is greater than $100,000, or by filling out a qualified dividends and capital gains worksheet if part of your income includes those types of income. 3 examples. Tony is single with a taxable income of $42,552 with neither qualified dividends nor capital gains. To determine his income tax, he consults the tax table, and here, where his income intersects with his filing status, gives him an income tax liability of $4,877. Thomas and Alva are married and file jointly with a combined income of $185,000. They use the tax computation worksheet and see that they have a 22% marginal income tax rate. They calculate their income tax by taking 22% of their taxable income and subtracting $9,894, which is the amount of their taxable income that is not subject to their marginal tax rate. This results in an income tax liability of $30,806. Bill files as head of household, and his income of $73,640 includes $225 in qualified dividends plus $5,560 in capital gains. Bill figures his income tax by first doing what Tony did, then using the resulting figure to complete a qualified dividends and capital gains worksheet, giving him an income tax liability of $8,028. I've covered the qualified dividends and capital gains worksheet in other videos on this channel, and a playlist of those videos is linked above or on the end screen of this video, so I won't go into the details as to how it was filled out. To the income tax figure may be added any repayments of the advanced premium tax credit or clean vehicle credit, plus any alternative minimum tax. These taxes are shown in Part 1 of Schedule 2. The resulting figure is important because this is the maximum amount of non-refundable tax credits you can claim. If you have more non-refundable credits than income tax liability, any remaining non-refundable credits are lost, although there are a few exceptions where these excess credits can be carried to next year's tax return. To arrive at the total tax liability on line 24, you take your income tax liability, subtract any non-refundable credits, and add back any additional taxes. These taxes are listed in Part 2 of Schedule 2 and include self-employment tax, any penalties associated with tax-deferred retirement plans, additional Social Security and Medicare taxes, and net investment income tax. Non-refundable credits cannot be used to reduce these taxes. This total tax liability is the most important figure on your tax return. Your aim should be to get this number as low as possible. The total tax liability is compared with the total of payments, such as withholding, and refundable credits, such as the Earned Income Credit or Additional Child Tax Credit. If the payments and refundable credits are greater than your total tax liability, the difference is a refund. If they are less than your total tax liability, you will owe money to the IRS. Let's see how all this comes together. Jill is a self-employed house cleaner with net business income of $21,750. She files as head of household and has 2 children. Her adjusted gross income is $20,404. Since this is under the standard deduction of $20,900 for a head of household, she has no taxable income, and thus her income tax liability is 0. Even though she has childcare expenses, she cannot claim a child care credit because it is a non-refundable credit. Her total tax liability consists of $3,073 in self-employment tax. To this is applied any payments or refundable tax credits. She didn't make any estimated payments, but she is entitled to an earned income credit of $6,960 and additional refundable child tax credit of $2,888. Subtracting her total tax liability from the sum of the EIC and the ACTC gives her a refund of $6,775. To review, your income tax liability is determined using your taxable income, filing status, and nature of your income. To this may be added repayments of advance credits and alternative minimum tax. From this are subtracted any non-refundable tax credits. Other additional taxes, such as self-employment taxes and additional Social Security and Medicare taxes, are then added. The resulting total tax liability is the most important number on your tax return. The lower this number is, the less tax you're paying. Links to additional resources and information can be found in the video description. Give the video a like if you found it informative, and share it with anyone else who could find it useful. Subscribe for more oversimplifications of our overcomplicated tax system. And your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.